me now for the next 15 minutes are some very esteemed gentlemen, and we're going to be discussing and tackling the deficiencies of Basel III in the financial regulation area. And one of the key concerns that a lot of these gentlemen have is that this Basel III will actually be harmful to trade flows. So joining us to discuss all of this is Stephen Beck. He is the head of trade finance at the Asian Development Bank. Next to him is Adnan Ghani. He's the head of global trade finance at RBS. And last but not least, Alexander Malaket, president of OPUS Advisory Services International. Thanks to all of you for joining us. What I've been doing throughout the week here on Sibos Television is, we have people from all around the world. We want to put our discussions in context of the broader view. So a lot of people may not, if they're operating in other parts of the world, may not know what we're talking about with Basel II, Basel III, and I understand there's Basel IV, and it keeps going on. So tell me, Adnan, what is the difference between the regulations that we saw in Basel II and Basel III?
That's a very good question. Thank you, Kavita. So basically, in the last crisis, Europe alone had to put in almost 1 trillion euros to help calm the situation. And it caused Europe a contraction of 6%. So the situation was very dire. What the regulators realized was that when they looked at the capital, there wasn't sufficient capital in the industry to cover the losses. Banks had frozen liquidity, so they had stopped lending to each other, and they did not have enough liquid assets to continue their operations. And thirdly, the banks were over-leveraged, so they had lent much more in comparison to their capital. So Basel III basically aims to correct some of these aspects by putting in things like the liquidity coverage ratios, a leverage ratio to contain the amount of leverage, and to increase the capital that banks have in the system to be able to bear such shocks.
But you guys, trade finance professionals and market practitioners, are really worried that that's going to hurt your business. Tell us exactly why. Stephen, if I could start with you.
Yeah, well, I work for Asian Development Bank, as you mentioned earlier, and as a multilateral development bank, we're not subject to any of the regulatory requirements from any jurisdiction. So while we're not impacted directly, we're concerned about the unintended consequences around Basel III. Why? Why? Because it makes no distinction for trade finance as a separate asset class. So the cost of capital to do a relatively higher risk transaction, higher margin transaction, is the same as doing a relatively lower risk trade finance, lower margin transaction. So our concern is that banks are going to be wanting to do more of the sort of riskier business, moving away from trade finance specifically, which of course is the antithesis of what Basel intends to do in the first place, right? But also from a multilateral development bank perspective, our trade finance programs have grown exponentially and now represent huge operations within ADB, certainly IFC and other multilaterals. And it's actually difficult to keep up with the amount of demand that's on our programs, because the more stringent the regulatory environment, the more the commercial banks want to lay off onto multilaterals, because when they lay off some of these risks, they get capital relief.
So basically, Kavita, when we talk to the regulators, as I just mentioned, the intended consequences are all something the industry agrees with.
Yeah.
We all want a more stable financial system. What we're trying to highlight to the regulators is that it has a direct impact on creation of jobs, especially in the small and medium-sized enterprises, as well as helping a country trade its way out of a recession. And immediately, I must admit, the regulators are very sympathetic to this. So we've been highlighting the fact that Basel III has certain stipulations which may actually restrict the amount of trade a country is able to do, and it will have a significant impact on emerging markets and small and medium-sized enterprises. So far, every regulator we have spoken to, and BAFTIFSA is kind of leading this initiative, have been very sympathetic, and I think we will be making some headway.
Well, I want to bring you in, Alexander, because these are two gentlemen from really large institutions, and he mentioned SMEs. Tell me what your take is from your perspective on the discussions we've heard so far.
Thank you, Kavita. In fact, I'd like to pick up on both Stephen's and Adnan's points. If we take the discussion up a level, the concern really extends beyond just the financial sector into trade more broadly. Political leaders, business leaders across the globe are looking at export-driven recovery as a key strategy in terms of getting the global economy back on track. And one of the issues that people are concerned about, when you think that 80 to 90% of global trade flows have a financing element attached to them, is that if the trade finance element doesn't work well, as we saw at the peak of the crisis, trade flows evaporate. And so that whole strategy of using trade as a recovery is a concern and should be a concern to business executives, small business owners, and political leaders across the globe. So from my point of view, as a somewhat of an arm's length observer of this business, that's the crux of the issue.
So it seems as the regulators have their ear to the ground, they seem to be quite welcome to the ideas that they've heard and listening. You know, in some of the conversations that you've had, what advances have you made to the kinds of things we're likely to see coming down the pipe, say, in the next couple of years?
Well, up until recently, we didn't really have any solid statistical ground on which to take a discussion forward with Basel and other regulators. We weren't able to prove what we all know intuitively, which is that trade finance carries a relatively low probability of loss. So what ADB did is we worked in conjunction with the International Chamber of Commerce, and we got together 9 large trade finance banks, and we accumulated data on trade finance transactions, over 5 million of them, going back over 5 years, including over the global financial crisis period. And what we see on that data is that the probability of default on the over 5 million transactions was 0.02%. So we were able then to have a very solid basis on which to have a serious discussion with the Basel Committee, which is what we've done. And fortunately, they seem quite receptive to the arguments.
So basically, Kavita, there are 2 things in a document that has recently come out called the Capital Requirements Directive, CRD4, that are very, very encouraging. The first one is that it does ask all regulators to use something on the maturity profile more consistently. The second, which is something also very encouraging in the CRD4, which is up for debate, is that it stipulates the formation of a task force to look at the unintended consequences on trade. Now, this is really coming from the regulators, so that does give us a lot of comfort that the regulators are listening and do not want the unintended consequences of Basel III.
All right, well, let's get some final comments from you, Alexander.
Thank you, Kavita. In terms of the progress, for me, what I'd like to highlight is the maturing of the dialogue around this whole question of financial regulation, particularly as it relates to trade finance. Even when we think back to Sibos in Amsterdam last year, the level of engagement of financial sector executives and particularly trade executives has progressed significantly from my point of view as a consultant and as someone who writes for the trade press. The dialogue is maturing. We need it to continue. I heard the earlier segment, one of the speakers saying trade finance will survive Basel III, and it certainly will, but it's not the moment to start to take a passive approach to this whole discussion. The engagement needs to continue, it needs to broaden.
Okay.
We need some non-OECD regulators in the dialogue, as one of our speakers yesterday said. We need to get some corporates involved in the dialogue, as we're seeing start, and so we just need to get those that are impacted further engaged in this discussion.
All right, well, we'll leave it there. Thanks very much to all of you for joining us, Stephen, Adnan, and Alexander. It's been a pleasure here to have you on Sibos TV.